The following podcast was recorded on Tuesday, November 17th, 2020. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome to the latest edition of Talking Data. Our Talking Data series seeks to offer timely insights into macro market themes along with macro data and its impact on the economy and markets. I'm Kristen Radosh of Arbor Research and Trading, and as always, I will be your host today. Our presenters are Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today, our topic is what could go wrong. Jim, we're going to get started with you today. The last week has seen a massive rotation from work from home to reopening. Why is this happening?
Yeah, thanks. And that is why we wanted to address this, is that last week's rotation was not just a rotation. The move, the move from growth to value, from work at home to reopening, or whether you want to measure it from large cap to small cap, by some measures was the largest ever rotation in a day or a week that we've ever seen. And some of the data goes back to World War II. So it has been a massive, massive move. And it's all been driven by this idea that the vaccine is coming. We're all living in the second half of 21. And that it's, I know that, it doesn't look good now when you look at the COVID numbers, but don't worry about now. Look at the second half of the year. It's going to be much, much better. That's really what has been igniting everybody's excitement. Bank of America is out with a survey today of institutional money. They're the most excited that they've been about the stock market in 20 years right now. And there seems to be more and more people throwing out this phrase, roaring 20s. Here we go again. And that, just like 100 years ago, and I look forward to Ben doing the flapping thing as well too, and that we're going to see the market keep going up. I thought that because that is a well understood theme, that we could maybe just discuss what could go wrong with it. And Ben, I'll throw this out to you. The first thing I want to throw about what could go wrong with it is valuation. The market's valuation, if you look at the forward PE ratio, which is Wall Street's favorite metric, or market cap to GDP, price to dividends, EBITDA, take your pick, it's pretty close, if not exceeding the 2000 bubble peak. To use one example, probably the most bullish number I've seen on the street is JP Morgan suggesting that the S&P, which is at 3,600 now, will be at 4,500 at the end of next year, and they're assuming $178 on earnings. That is a 25 PE. That is a higher PE than we had in 2000, when everybody is in agreement that that was a unsustainable bubble peak. But now it seems like we expect this unsustainable bubble peak to stick around and be kind of like the new neutral at that point. So what's your thoughts about the valuation argument when it comes to where we're going to go from here?
So really over the past 10 to 20 years, the market, or really the economy, has changed in that imperfect competition, oligopolies, monopolies have become so much more dominant, and that's the most noticeable for sure within the technology space. So as you get these gross margins, productivity, to really go to these large caps technology companies, which are running gross margins somewhere around 33 to 34% relative to small cap companies that are getting left behind around 24, 25%. I think that's allowed these valuations that are lofty to really kind of not scare investors so much, because we just know so much of the sales on a percentage basis, so much of the productivity is getting funneled into these large cap companies. So I think there's a risk, of course, going forward on the regulation side with Biden. I don't think that's really being priced or in too much. We saw a little bit of that with the rotation maybe after September 25th, 26th, when Biden started to take a pretty noticeable lead in the polls. But I think that the euphoria that we've seen in equities, is coming again due to the vaccine. This rotation to value, I don't think will persist for that much longer. I'd be pretty shocked if it did, but I wouldn't be surprised to see technology more stable to kind of sideways into year end, while money is funneled into large caps within the industrial materials, potentially energy space that could perform quite well as the economy gets back online and as we produce more stuff and the outlook improves, for, like I said, for second quarter of 2021.
Yeah, all that's good, and I don't disagree with any of it. My concern is when I look at the data from Wall Street, and I looked at it this morning, and you look at the estimates on earnings, and you look at the GDP numbers, I don't see anybody really marking up their numbers in light of the vaccine, in large part because they sort of expected one before we got the Pfizer announcement last week, that there was going to be some level of vaccine or some level of treatment that was going to come by the end of 21, and that was largely in their numbers. I hear what you're saying about large cap stocks and their monopoly and their big margins, that they can push the needle on that. But this rotation into value stocks, energy stocks, consumer discretionary, financials and stuff. If you look at the S&P Value Index forward PE, it's even higher than the overall index right now. It's in the low 30s. And so that's the biggest issue that I see that the market has to deal with if we're going to have some kind of a really powerful rally. It's going to have to come from a state of what we understand is overvalued, and at least staying there, if not going more overvalued. Because right now, I don't hear anybody saying that, oh, no, Wall Street's got these earnings numbers all wrong. There's going to be a massive markup in these earnings that's going to bring down those valuation numbers as well we go from here. So in what could go wrong, at least in the start, I think it's definitely in the valuation camp. Of course, there's always, that the vaccine turns out to be a bust, but I have no idea if that's true or not. I'm assuming it's not. The other thing that could go wrong is that there's a general pushback that people just don't want to get vaccinated. The country becomes anti-vaxxer to some degree. I don't know if that is, and I'm going to assume not as well too. Before we move on to our next bullet point, Ben, you got any thoughts on this topic?
Yeah, I think at the root here too is what we haven't discussed is savings. So with the CARES Act and the degree of hefty saving that was done from April through July, August, there is still 70 billion plus to be spent by the consumer over the next maybe 9 months or so. So maybe they've gone through 30 to 40% of those savings, but there's a lot there. So I think the big question mark, what could go wrong, is with the consumer. It depends on, with them deleveraging, their propensity then to spend here moving forward is what matters. So if that vaccine is critical, that's going to keep things going. How COVID, of course, goes over the very short run is going to dent spending. We've already seen that with retail sales for last month. But the big question mark will be how much and how willing are consumers willing to spend over this holiday period through the end of December. That's going to be incredibly, I think, telling. And again, the vaccine's a big part of it. That's, to me, where things would go most wrong, as if they're not willing to unleash those savings at a pretty good clip.
What do you make about the idea that for the moment, as we're recording here, November 17th, it looks like a new stimulus package is nowhere right now. And at the end of the year, on December 31st, the eviction moratorium is gone. The pandemic relief program is gone. Pretty much any stimulus that's been left from the CARES Act disappears in 6 weeks, unless we get another deal together to extend it. If we're waiting for January 20th, that really depends on how the January 5th Georgia Senate races go. And even if the Democrats were to take the Senate, and by the way, predict it, if you want to use one metric, says 83% chance it'll stay Republican, they got to start from ground zero on January 20th to put together another stimulus bill. They're not going to have it ready probably till March or April. And so, there is that also that fear that, yes, the public has a tremendous amount of savings, but that creation of those savings through government transfers is about to end. And there's no talk about extending it in any degree. And it's been really amazing because Pelosi gives a speech and says we have to do this, more stimulus. Trump gives a speech, says we have to do this, more stimulus. Biden gives a speech, says we have to do this, more stimulus, and nothing happens. It's one of these rare things where we're all in agreement we want to do this, but it never quite ever seems to happen.
I think the big thing is we haven't seen the job market really wobble, and that's where it matters. I think one thing you brought up that's really true here, and something that Powell was just focusing on, minutes ago, is the structural unemployment hysteresis fear with 10 million jobs that we're still below in terms of baseline where we should be if we were to recoup all those losses. But I think we'll get a good flavor finally for this month, November, based on our alternative data and others. It looks like this will be the first month where we'll have some actual weakness within the job market potentially. We could have a flat number or worse. And I think we'll get a flavor then for how markets are going to react to the idea that, okay, the labor market's is hurting and starting to hurt more than expected, and we're not getting this stimulus out there to help push hiring, push job applicants, and help those that don't have jobs to continue to spend. That's when I think we'll get a flavor for for how much the markets will finally internalize that and react. I think it's going to be a bigger reaction than people think. Even though we do have all the savings, I do agree. I think the structural unemployment hysteresis fear is a real one. And that will come to ruse at some point. And I would say stay tuned for the first week of December, because I think we'll get an indication then.
Final thought, and then we'll go to the next question is, you're right, Powell was speaking earlier today, and I was watching him right up until we started this broadcast. And he did point out that at 10 million people still have not gotten back their job that they lost during the pandemic, that right now, even with the recovery to date, that's more jobs lost than we'd had during the Great Recession. So we've still got a long way to go. And even if you use Wall Street's estimates, by the end of 21, 5 million people will still not have gotten their jobs back. 5 million would have. You only have that number. The hysteresis problem will just exacerbate as we move forward from there. But let's move on to our next question. Kristen.
Yeah, so let's talk about the bond market and specifically the outlook. What is it signaling at 0.9%?
Go ahead,
Ben, do you want to get it?
I'll go first, since Jim and I are definitely going to probably disagree here. So so 90 basis points. I think they're down to 86 basis points or something right now. We saw this modest breakout higher in yields and long end yields. But for me, it feels like it's limping along. So typically during a bearish breakout to higher yields, that is lower prices, there's usually a thrust of volatility on higher implied volatility and expectations, and also higher inflation expectations too. But this time around, we're not getting that. We're getting much lower premiums at options, on swaptions. Even the hedging activity that was somewhat lopsided to higher yields, coming into the election, that's completely evaporated and is now at balanced. So there's the feeling, at least that's being shown by investors, is pretty lethargic. And I think the inflation outlook, and this is maybe where Jim and I are talking at two different directions, not two different directions, two different points. Over the short term, I think it's gonna be hard to engineer higher inflation. Are we gonna see 35, 40 basis point month over month growth in core PCE like we did in June, July? Probably not. We'll probably grow around 10 to 15 basis points. With the industrial economy coming back online, we'll finally get supply to hopefully increase. And then with COVID in the short term, that is dampening the consumer's willingness to spend to a certain degree. So I think that'll be potentially an unexciting story. I wouldn't be surprised to see yields skate sideways for quite some time, at least into the first quarter of next year. Now, regarding inflation, real quick, the one thing you have to remember is due to base effects, we're going to get higher inflation very easily on a year-over-year basis. We're going to see 2.5% core inflation if things just kind of go along their trend line as they have over the past number of years. Is that exciting? Probably not. So that's why I think we have to look at the month-over-month or 3-month annualized numbers. And it's all going to be predicated potentially on, do we get this other fiscal stimulus plan? How well is the vaccine working? Is industrial economy fully online? If all those things can line up, and again, I think I outlined 3 different things last time. I think then we can get the inflation story maybe in the second half. But for me, we got to see more than 50% of economies growing across the globe on a 1-year trend basis. Got to see 50+% of commodities producing year-over-year gains. And then we also need to see the markets internalize and produce a 50% plus probability that we can see sustained 2+% headline CPI over the next 10 to 30 years. That's still stuck around 50%. So all those are 50% hurdle for me. We get above that, great. And inflation's going, yields are going higher at the long end. But for right now, that's a very muddled, cloudy picture, and I still think sideways is the path over the near term.
I wouldn't disagree with you over the near term that sideways is the path. My argument has always been that, first of all, we have not had inflation for about 25 years. A lot of people have not really seen it. And so there's this assumption that doesn't get challenged that when rates go up, it means only one thing. Real growth is expanding. And when rates go down, it means only one thing, that real growth is contracting or decelerating into contraction. And so that's why we get excited when interest rates are going up, because we assume it's all about real growth. But it's really more about expectations for nominal growth. Nominal is real plus inflation. And if it is real growth that is expanding interest rates, that's good. That's good for risk markets. That's good for the economy. If it's inflation that's expanding in interest rates or the nominal, that's not so good. And we'll have to see. My contention has been that as we pushed out to 95, 97 basis points last week on the vaccine news, we also saw a little bit of a pulse out of the Fed Fund futures market. Hey, remember that? It started moving as well too. Now it's not pricing in a rate hike for the end of 2022, but it's really close to the end of 2022, where it was non-existent just 2 weeks ago. And that's how it starts. It first prices it out there at the end of 22, 23, and then it starts to move it forward. I would argue that you're right, Ben, because of the base effects. I think that the inflation story is after April, because that's the lockdown, that's the reopening, the year-over-year changes. We're going to see some big numbers in the inflation numbers after April. We could see multi-decade highs. 2.5% would be a 25-year high in core PCE if we get there. Then the question is, how do interest rates respond to that? Are they on their way to 1.25 to 1.5? If they are, my concern is that will be considered more on the inflation side that's pushing it because of all the stimulus that we've had, relative to the real growth side as well. So really, one of the things I want to push back on, at least at this stage of the cycle, is everybody looks at higher rates and goes, yes, good, more growth. Yeah, that's been the case, but it may not be the case as we go forward from here, depending on how it goes with inflation. Last thought for you, Ben, you mentioned we're going to bring the industrial economy back online and we're going to start producing more stuff. Unless we go back into lockdown here in the next 2 months because of the big surge of COVID, we might not get the industrial economy back online then at that point. So hopefully we get the industrial economy back online. And other thoughts?
Going on to what could go wrong, that's obviously high on the list. And I was just looking and updating the COVID briefings and press conferences, and now we have officials, governors, and so on, discussing quarantines and lockdowns in the U.S. At a pace of at least talking about it 7 different times within their briefings, which is well off the lows we saw of 2 to 3 times, somewhere in the end of August, beginning of September. So that is becoming front and center. It doesn't really, I don't think it'll hit markets unless it becomes an eventuality. But going back now, jumping back to the inflation story, if you want a good flavor for what when you should be concerned on equity front, risk assets front, is the simple metric to watch is the VIX versus US 10-year tips break-evens, or whatever your favorite inflation expectation measure is, and their correlation. And we've never really seen an appreciably positive correlation over the past decade or two. And the only time we really saw this kind of agitation of risk assets was really around Volmageddon, when the VIX and the 10-year tips break even actually did poke positive for the first time in a long time.
2018.
Yes. And so, but now we did actually poke positive last week. So the correlation is, 0, but it's like 0.03. If that is able to go appreciably positive, to me, that's like something like even 0.2. That becomes, I think, a huge story if that's the case. But until then, I'm really not concerned about higher yields until the markets truly show us that they're freaking out about higher yields. Looking at like the zombie story, or just overall funding for small caps, what is the big threshold there on a real yield basis? That's all the way up at 1%. If you look historically, kind of when there's this break point in terms of credit markets getting concerned and solvency, liquidity risks rising, that's somewhere around that 1% level on a real yield basis, which for me means it's a lot further away. I think, Jim, you'd say it's a lot closer than people realize, though.
Yeah, I would. All right, let me summarize, and then I'll give you a chance to summarize too, Ben. We didn't need to do a podcast on everything that's going right, that's pushed the stock market to new all-time highs. I mean, it's pretty well understood that, there was no contested election. The vaccine news stories, that both of them are out now. The markets are going, and we've seen a giant rotation towards the reopening of the economy. That's understood. But I think that in our mind, there's two big risks you got to look at. One, you're at a level of over, if not fully valued, overvalued with most metrics on the stock market. So you're not buying a cheap market. You're going to buy an expensive market, hoping that it will stay that way as prices continue to go higher. And the other one is inflation. I've often argued inflation is going to be the story of 21. Either it comes back, and that's a big story, or it doesn't come back. And you can look back to all the massive stimulus that we've done and say, boy, if that doesn't produce inflation, well, why do we need to stop doing it? At that point, let's just go full MMT after that as well. So those are, in my mind, the two biggest risks. How about you, Ben?
Yeah, so I think the valuation, that's a tough thing to grapple with. It's hard to refute what you're saying, and I think that's why we've seen so many bears start to come out on the technology front. But I just continue to fall back on, as long as they're not deregulated or regulated, and they're allowed to continue to see really the lion's share of sales, productivity go their way. I think these companies kind of, fortunately or unfortunately, continue to press on. That is also, getting to the inflation side, a force that does compress and keep yields low and inflation low too. So as that technology and really consolidation of really production, productivity, services, sales, and so on, that is going to weigh somewhat on inflation to a certain extent. Maybe that'll all change. Maybe there will be a wave of regulations next year with Biden. Doubtful if they don't get the full blue wave. But I think that the inflation story is going to be a snooze fest here for the short term. Seems like Jim and I agree on that for the most part. Next year is for me.
Lockdown too.
Especially if they're locked down. For me, it's a bigger question mark on the second half of 2021. Like I said, I've outlined 3 specific things I would need to see to kind of get enthusiastic about inflation expectations over the long run. But there's a lot to see here with the vaccine. There's a lot to see how consumers operate with their savings in terms of their degree of spending. So I'm not as enthusiastic about a rip-roaring rise in yield or the risk of it. And I think investors have kind of come around to that too for the most part. So it's a wait and see.
Okay, good. Kristen.
Thank you, Jim and Ben, for your thoughts today, and thank you to our audience for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our 2 most prominent research offerings are Bianco Research and Arbor Data Science. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at